Welcome back, Focus learners, to another Deep Dive Explainer. Today, we're tearing apart Module 19, Electronic Transfers and Modern Banking. And look, we aren't just glancing at generic ledgers here. We are applying what I like to call the advanced technical methodology for true A-star execution. I'm going to be shifting between two crucial roles for you today. First, I'll be your subject specialist, breaking down these automated digital workflows. And second, I'll put on my senior examiner hat, showing you exactly how marking strategies work so you can absolutely bulletproof your exam paper. Okay, let's dive into this. Here is our masterclass roadmap for today. We're kicking off with the architectural foundation, jumping into method marks and technical execution, exploring AO3 ratios and evaluation, tackling essential examiner pitfalls, and finally, wrapping up with an A-star challenge. Let's get moving. Section 1. The architectural foundation, focusing on the core concepts for the syllabus updates. Cambridge demands 100% accuracy with modern international terminology, especially as we shift further into automated cloud accounting. What we used to call bad debts are now strictly referred to as irrecoverable debts, which, by the way, are often flagged automatically by modern banking software. And capital? That's now owner's equity. Remember, when a digital BACS transfer clears, it instantly updates the fundamental accounting equation, where assets equals liabilities plus equity. If you use outdated terms on the exam, examiners are literally going to penalize you. Now, what's really interesting about this slide is the tension between these two concepts. In our modern era of instant electronic transfers, the historical cost principle dictates that we record assets at their original purchase price. But then the prudence concept steps in and demands we never overstate our profits. For instance, if an electronic transfer involves wildly fluctuating foreign exchange rates, prudence requires us to recognize potential losses immediately. Inflating those digital profits, that is a massive red flag to interested parties like banks and tax authorities. Section 2, Method Marks and Technical Execution. Think like a senior examiner with me now, because this is where the battle for the A-star is really fought. Let's trace this procedural flow. In modern accounting, the source document is often an electronic bank feed. From there, it flows to the books of prime entry, then straight to the T account, over to the trial balance, and finally into the financial statements. The absolute golden examiner rule here is method marks. In your practical coursework and your exams, when you're dealing with complex digital error corrections, you must document your evidence. Show your formula, show your procedural logic. Even if your final calculator output is completely wrong, showing those workings guarantees you get those method marks. While cloud software automates a lot of this today, you still have to deeply understand the underlying T-account logic to fix errors manually. The T-account really is the gold standard of double-entry bookkeeping, and honestly, it is shocking how many students lose easy marks just by confusing balance C/D, the figure carried down to close the current period, with balance B/D, the opening figure brought down to start the brand new period. Reversing these two in a manual adjustment is basically handing your marks straight back to the examiner. Here is another massive mathematical pitfall: miscalculating percentages for discounts. You have to clearly distinguish between the two. To help you out under exam pressure, here's a quick memory hack. Trade for the tag, cash for the clock. Trade discounts reduce the upfront tag price because of bulk buying, and they are not recorded in the double entry. Cash discounts, however, reward you for beating the clock with a prompt electronic payment, and those absolutely must be recorded in your books. The strict procedural logic is to apply the trade discount first, then the cash discount. Never, ever just add the percentages together. Section 3, AO3. Ratios and evaluation. Time to upgrade our skills from a basic bookkeeper to an investigative financial intelligence analyst. And this brilliantly illustrates the ultimate A-star trick scenario. Look, calculating a ratio is just a baseline skill. Identifying what it actually means, that is A-star territory. Imagine you are presented with a scenario where a firm's current ratio has plummeted from a super healthy 2.5 to 1, all the way down to a concerning 1.1 to 1. On the surface, it looks like the business is suddenly struggling to cover its short-term liabilities. Using the advanced technical methodology, we need to debate the cause and effect chain here. So, why the drop? Have they massively overpurchased inventory? Are trade payables being settled way too slowly? Or did rapid electronic payments completely deplete their cash reserves for some huge capital expenditure that really should have used a long-term loan instead? Are trade receivables failing to clear, starving their liquidity?
You need to evaluate this exactly like a financial auditor investigating a digital cash flow crisis.
To connect this to the real world, just look at modern fintech. Platforms like Xero completely automate prime data entry and handle instant electronic bank transfers. The algorithm processes the raw data, sure, but it relies entirely on your human AO3 investigative skills to interpret those underlying ratios and make strategic decisions. Cambridge weights this human evaluation incredibly heavily because it's what determines if a business actually survives. Section 4. Essential Examiner Pitfalls. Let's look at some urgent, critical warnings directly from recent principal examiner reports. Take a second to read this direct quote. Students often lose marks through poor handwriting. Now you might be thinking, in an era of AI and electronic banking, why on earth does handwriting matter? Because in paper 2, you are physically writing out manual ledger adjustments for automated errors. If your examiner literally cannot distinguish your 4 from a 9 in a densely packed adjustment column, you lose your method marks. It's that simple. Manage your time effectively so you aren't rushing and scribbling for these physical ledgers. The second major warning is misclassifying revenue versus capital items. So the crucial point is understanding this specific technical difference within a digital context. Revenue items are your day-to-day running expenses, right? Things like digital software subscriptions, which reduce profit and go in the income statement. Capital items, on the other hand, involve buying or upgrading long-term assets, like purchasing bespoke banking servers for the statement of financial position. If you misclassify an electronic payment for a capital asset as a simple revenue expense, you drastically break the entire accounting equation. Part 5. The A-Star Final Challenge. Let's bring the energy up and consolidate everything we've covered today. I want you to pause and really think about this multi-layered scenario. When you're doing an inter-firm comparison, way beyond the basic numbers, how do non-financial factors ultimately impact the return on capital employed? Think about things like having a highly secure, frictionless electronic payment system. It boosts consumer trust, elevates your market reputation, and even improves staff morale. These non-financial factors aren't directly sitting there in the T accounts, but they absolutely dictate the long-term quality of the firm's profit. True A-Star accounting evaluates this complete, complex chain. Keep practicing your procedure logic, always document your evidence, and I'll see you in the next explainer.